Hello and welcome. Ending a business partnership, it can feel like one of the most stressful things you'll ever go through, but it really doesn't have to be a nightmare. In this guide, which we've developed with the top experts at Pro Tax Accountant, we're going to give you a clear step-by-step plan to navigate this whole process smoothly.
It's a common story, isn't it? What starts with big dreams and shared goals can, for all sorts of reasons, lead to that tough decision to part ways. And just like that, you're staring at a mountain of legal paperwork, complicated financial sums, and tax rules, and it's easy to feel totally lost and not even know where to begin.
But imagine you had a roadmap, something to guide you through that maze. Well, that's exactly what we've got for you today. We are going to break down every crucial step for dissolving a partnership here in the UK, from your legal duties to the smartest way to handle the taxes. So let's dive right in.
Okay, first things first. The most critical step in any partnership split is to figure out the rules of engagement. And that all starts with one key document, your partnership agreement, assuming you have one, that is.
Think of your partnership agreement as your custom-made rule book. It's the plan you and your partners made, hopefully when things were good, that lays out exactly how a split should work. But if you don't have one, the law steps in with a default set of rules called the Partnership Act of 1890. And get this, it's a piece of Victorian-era legislation. It was designed as a one-size-fits-all solution, which means it can be a pretty blunt tool that might not suit your modern business at all.
Here's our first pro tip, and it's a big one. It is honestly amazing how many partnerships just run on a handshake. So many people have no idea that without a formal agreement, that old 1890 Act means everything gets split 50-50. That's all assets and all debts split right down the middle, no matter who put in what. So if you invested 80% of the money and your partner only put in 20%, well, the law says you both walk away with half. That can be a huge and very painful financial shock.
Right, so whether you have that agreement or not, there is a formal legal process that you absolutely have to follow. This is what makes the dissolution official, and crucially, it protects everyone from problems down the road. Let's walk through those key steps now.
Following these 4 steps is your best defense against any future disputes. First, agree on everything, profits, assets, debts, and get it all in writing. Then, you serve a formal notice of dissolution to all partners, which officially sets the end date. After that, you draft a final, legally binding dissolution agreement. And finally, telling everyone, your clients, your bank, your suppliers, isn't just good manners. It's a legal step to untangle the business from its obligations.
So, once the legal wheels are in motion, it's time to wind up the partnership's finances. That basically means settling all the business's debts, and then, finally, sharing out whatever's left. Now, this is a point of law you really need to understand. You cannot pay yourselves, the partners, a single penny until every single outside creditor has been paid in full. We're talking suppliers, landlords, anyone with a loan, and of course HMRC. The law is incredibly clear about the order of payment. Creditors always come first.
And when we talk about what needs to be divided, it goes way beyond just the cash in the bank. Of course, there's the physical stuff, equipment, property, stock. But you also have to account for the intangible assets. Things like your brand's reputation, what's known as goodwill, your client lists, and any intellectual property. All of that has a value, and it all has to be part of the final calculation.
So, how do you figure out what everything is worth? Well, while you and your partners can agree on your own way of dividing things up, the default legal position is actually to sell all the assets on the open market. Why? Because a public sale is seen as the fairest and most transparent way to get a true market price, which ultimately protects everybody involved.
Okay, let's move on to tax. Pay close attention here, because this is where a lot of people can make some very expensive mistakes. But don't worry, we are going to walk you through exactly what you need to know to get it right.
So, when you dissolve a partnership, HMRC sees it as you disposing of your share in the business's assets. Just think of it like you're selling your stake. And if those assets are worth more now than when you first got them, you might have to pay capital gains tax on that increase in value. That's the gain.
Let's make this real with an example. Meet Chloe and Liam. They're a design duo in London. They decide to dissolve their partnership and they sell their small office. They make a total gain of £100,000 on the sale. Now that gain is split between them according to their shares, so they each have a personal gain of £50,000. And here's the key thing. Chloe and Liam are then individually responsible for telling HMRC about their £50,000 gain and paying any tax that's due on it.
Now, you absolutely cannot afford to ignore the HMRC deadlines. If your partnership stops trading during the 2025-26 tax year, you need to inform HMRC by the 5th of April 2026. Then the final partnership tax return and your own individual self-assessment returns are all due by the 31st of January the next year. Missing these dates can trigger automatic penalties, so please get these dates into your calendar right now.
But that is not all when it comes to tax. And this is where a lot of people really go wrong. They don't realize that there are strategies you can use to seriously reduce your tax bill. Stay with me because this next part could genuinely save you thousands of pounds. This is a potential game changer. One of the biggest tax-saving opportunities is all about how your final payout is classified. Instead of being taxed as income, which can be at rates of 40% or even higher, the money you take out can often be treated as a capital gain. And as we're about to see, the tax on capital gains is usually much, much lower. This is made possible by something called Business Asset Disposal Relief, or BADR. Some of you might remember it by its old name, Entrepreneur's Relief. It is a hugely valuable tax relief that can slash your capital gains tax bill, and it's easily one of the best tax reliefs available to business owners here in the UK. 10%. That's the magic number to remember. With Business Asset Disposal Relief, the tax rate on your qualifying gains drops to just 10%. This can mean a truly massive saving compared to paying the standard capital gains tax rates. Let's go back to our designer, Liam, and his £50,000 gain. Look at this difference. If it were somehow taxed as income at the higher rate, he'd pay a staggering £20,000 in tax. Under the standard capital gains tax rules, his bill would be £10,000. But with Business Asset Disposal Relief, his tax bill is cut in half again, down to just £5,000. That is a 75% saving compared to the income tax rate. It's an enormous difference. So, the big question is, are you eligible? Well, for partners, the main rule is that you must have owned your share of the business for at least 2 years, right up to the date you dissolve it. There are a few other conditions as well, so it's absolutely essential to get some professional advice to check your specific situation. Okay, we've covered the legal path, the financial split, and the all-important tax strategy. So in this final section, let's just run through a quick checklist of the very last steps you need to take to make sure it's a clean, complete, and final break. Think of this final checklist as your guide to a stress-free finish. By methodically ticking off every single one of these points, you can avoid any of those horrible legal or financial surprises popping up months or even years later. This is your path to getting some real peace of mind. Look, as we've seen, dissolving a partnership is definitely a complex process. But with the right advice and support, you absolutely can get through it successfully. By taking the time to understand your duties and plan your exit properly, you can protect your financial future and move on to your next chapter with confidence. And of course, we have to say that the information in this guide is for general guidance only, based on the rules as of November 2025, and it really shouldn't be used as a substitute for professional advice. Tax rules are complicated and they do change. So for expert advice on dissolving your partnership or any other tax matter that is specifically tailored to your situation, you must consult a qualified expert. You can get in touch with the specialist team at ProTax Accountant directly. Their details are right there on the screen. Thank you so much for watching.